Welcome to the Deep Dive. We're the place that cuts through the noise, getting straight to the essential insights on, well, often complex topics. And today, we're plunging into a really fascinating corner of the global economy. It's something that touches millions of people, maybe even you, every single day, possibly without you even realizing it. We're talking about specific purpose payment solutions, and our focus today, Edenred. Just imagine a company that manages how you pay for lunch at work, or maybe how a huge delivery fleet refuels its trucks across different countries, or even how vital social aid gets distributed. That's Edenred in a nutshell. So our mission for this deep dive is to really unpack an in-depth investment analysis of Edenred. We want to reveal its, frankly, ingenious business model, its impressive financial strength, its vision for the future, the competitive world it operates in, and naturally, the risks and opportunities that are shaping its path forward. We've gone through a stack of expert analysis and pulled out the most important nuggets for you. All right, let's dive right in. When we say specific purpose payment solutions, what does that actually mean? And who exactly is Edenred in this whole picture?
Right. So at its heart, Edenred is a global leader. It operates this pretty sophisticated B2B2C digital platform. Think of it like a central connector.
Yeah.
A big digital bridge creating this really valuable ecosystem.
B2B2C. So business to consumer.
Exactly. And this isn't some small operation. It's truly massive. We're talking about linking roughly 1 million corporate clients.
1 million companies. Wow.
Yeah. And then over 60 million employee users, the people actually using the benefits, and connecting them to more than 2 million partner merchants.
Okay.
All across 45 countries. It's this huge, intricate digital web facilitating very specific kinds of payments and services.
So a global network, really?
Absolutely. Now, their core business is basically structured into three main segments, strategic divisions.
Okay.
The first one, and it's the biggest by far, is benefits and engagement. This makes up 65% of their operating revenue.
Okay.
In 2024, that was 1.7 billion euros.
65%. That's the lion's share.
It is. And it saw really strong growth, too, 13.1% like-for-like. Its most famous product, the one people probably know, is the ticket restaurant a meal voucher.
Ah, yes, the classic lunch voucher.
The classic. But here's the key thing. Their strategy now is extend beyond food. It's not just about lunch anymore.
Right. They're moving past that.
Exactly. They're actively diversifying, think gift cards for all sorts of things, comprehensive wellness programs that could be gym memberships, mental health support, you name it, and even these quite sophisticated employee engagement platforms, things designed to keep the workforce connected and motivated.
So much broader than just meals.
Much broader. And a really pivotal move here, underlining this whole Beyond Food strategy, was their big acquisition of Reward Gateway back in 2023.
Reward Gateway, I remember that. Wasn't that a huge deal?
It was substantial, 1.3 billion euros.
Yeah.
And it wasn't just adding something on the side. It's really central to their ambition of building this integrated, holistic platform for employee well-being.
Holistic, covering everything an employee needs.
Pretty much. Addressing that whole spectrum of what today's employee needs to feel supported, valued, engaged, especially now.
Okay, that makes sense. So that's benefits and engagement. What's next?
Next up is mobility. This is another really key growth engine for Edenred. It represents about 24% of their operating revenue.
Still a big chunk.
Yeah, 624 million in 2024. And it grew nicely too, 11.3% like-for-like. This segment is all about fleet and mobility management solutions.
So company cars, trucks?
Exactly. Things like the well-known fuel cards, but it goes way beyond that. Think automated toll payments, maintenance services for corporate fleets, managing business travel expenses, streamlining all that.
Right, the logistics side.
Precisely. And their strategy here kind of mirrors the other one. It's called Beyond Fuel.
Beyond fuel. Okay, consistent theme.
Very. They're aggressively expanding, adding services like integrated toll and maintenance solutions, trying to optimize the whole fleet operation. And crucially, they're investing heavily in EV, electric vehicle charging solutions.
Ah, the transition to electric. That's huge for fleets.
It's massive. And this isn't just, following a trend. It's a strategic necessity for them. They want to be the essential partner for companies making that shift to sustainable transport.
Positioning themselves for the future of mobility. Makes sense. And the third segment.
The third one's called complementary solutions. It's the smallest, about 11% of operating revenue, bringing in 283 million in 2024. Growth was flatter here, 0.7% like-for-like.
Okay, what falls under complementary?
It's a bit of a mix. You've got corporate payment services, things like secure virtual cards for smoother B2B transactions.
Right.
Then, interestingly, public social programs. Here, Eden actually partners with governments and public authorities to distribute social aid efficiently.
So like welfare payments or specific aid programs.
Exactly, making sure the funds get to the right people transparently. And they also manage various incentive and rewards programs for businesses, maybe for sales teams or customer loyalty.
So a bit more niche, but using the same core platform.
Precisely. While it's smaller revenue-wise, it's an important area for innovation. They leverage their core payment tech to tackle these specific needs, expand their reach, and sometimes it acts as a testing ground for future bigger ideas.
Okay, so it's clear this isn't just about those old school paper vouchers anymore, not by a long shot. It's a vast digital ecosystem touching so many parts of daily life and business. You've painted a picture of a company really deeply embedded in how modern commerce works. What does this massive digital shift actually mean for, say, us, the people using these services day to day, or the companies offering them?
Yeah, you've hit on a really critical point there. This whole transformation, it means a dramatically smoother, more efficient, and more integrated experience for everyone involved.
Smoother how?
Well, think about it. If you're an employee using a meal benefit, it means instant access, maybe on a card or a mobile app, no more paper. If you're a business managing a fleet, it means real-time data on fuel consumption, toll costs, maintenance needs, all in one place. And even for a public authority distributing aid, it means better tracking, less fraud, more efficiency. For employees, it's instant access, digital wallets, sheer convenience. For businesses, it's real-time data, cost savings, simplified admin.
So value across the board.
Exactly. It's about creating efficiency and, frankly, undeniable value at every single touch point within this really complex network.
Right. Now, here's where, for me, it gets really interesting. This B2B2C model. With all these different players, corporates, employees, merchants, even public bodies, it sounds like a very complex web. How on earth does Edenred manage to create value for all of them at the same time? And maybe the bottom line question, how do they actually make money from orchestrating all this?
It really is an ingenious design, isn't it?
Right.
Edenred's model is built on what we often call a three-sided network. Though you could argue, as you mentioned, it's even four-sided when you bring in the public authorities.
Okay, 3 or 4 sides. How does that work?
It creates this powerful virtuous cycle.
Yeah.
Think about it. If you have a larger base of corporate clients signing up, that means more employee users get brought into the system. Millions more people with Edenred cards or apps.
Okay, more users.
Which in turn makes the platform incredibly attractive to partner merchants. Suddenly, there's this large guaranteed pool of potential customers actively looking to spend their specific benefits, whether it's lunch money, fuel, or something else.
Ah, so the merchants want access to those users.
Exactly. And then a wider, more diverse network of places accepting Edenred makes the platform even more valuable back to the corporate clients and their employees. It offers more choice, more convenience.
So it feeds itself. More users attract more merchants attract more companies.
Precisely. It's a classic network effect. And as you said, public authorities also benefit hugely. They get an efficient way to distribute social benefits, and in doing so, they help formalize local economies. Transactions move from cash to traceable digital payments.
Formalize, meaning less under-the-table stuff. Better tax collection.
Exactly. It channels transactions through official networks, reducing the shadow economy, improving tax collection. A win for the broader economy, too.
Okay, so everyone gets something. Let's break down that value prop a bit more. For the companies.
For corporate clients, Edenred solutions are, well, they're powerful tools. Especially now, in this tight labor market, they help enhance employee attraction and retention. Good benefits matter.
The war for talent.
Absolutely. Plus, they significantly improve payroll efficiency, less admin hassle. And they streamlined expense management, cutting down on paperwork and costs. Big savings there.
Makes sense. And for the employees using it.
For employee users, it translates directly into increased purchasing power for essentials like food or commuting. It boosts their sense of well-being, having easy access to these benefits, and honestly just a much simpler user experience for daily needs.
Like that single app idea you mentioned.
Yeah, imagine one app for your meal card, your transport costs, maybe accessing wellness discounts. All super simple.
Convenient. And the shops, the merchants.
For partner merchants, joining the Edenred network means pretty much guaranteed increased foot traffic. You've got millions of users directed toward them. That means boosted sales.
Okay.
And beyond just sales, they also get access to tools, data-driven tools for engaging consumers, running loyalty programs, helping them build stronger customer relationships.
So more business and better tools. And finally, The public authorities.
For public authorities, it's about efficiency, security, transparency in distributing social benefits, making sure aid gets where it's needed, quickly and safely. And, as we said, that broader economic benefit of formalizing the local economy.
Okay, that ecosystem makes a lot more sense now.
Yeah.
So how do they monetize this? Where does the actual revenue come from?
Right, the revenue model is primarily what's called a dual fee structure.
Dual fee.
Yeah, they earn from both sides. First, they charge fees to the corporate clients. Typically, this is a percentage of the total face value of the benefits being issued.
Okay, fee from the company.
Second, they earn commissions from the partner merchants when the employees actually redeem their benefits at the shop or restaurant.
Ah, so a cut from the merchant too.
Exactly.
Okay.
A fee from the client, a commission from the merchant. That's the core. But what's interesting is how it's evolving. They're actively adding more recurring revenue streams.
Recurring. Like subscriptions.
Kind of. Think software as a service or SaaS, fees for access to their platforms, especially the more advanced HR or mobility management tools, or subscription packages bundling different services together.
So moving towards more predictable income.
Precisely. It enhances their revenue visibility, makes earnings less bumpy, more stable over time, less dependent on just transaction volume.
Okay, dual fees plus growing recurring revenue. But I heard you mention something else. The float. That sounds intriguing.
Ah, yes, the float. This is a really crucial and, frankly, highly profitable part of their financial engine. It really sets them apart.
Okay, explain the float. How does that work?
The mechanics are actually quite straightforward, elegant even. Edenred receives the funds from its corporate clients up front when the benefits are first issued onto the cards or apps.
Right, the company pays Edenred first.
But Edenred only pays the merchants when the employee actually uses the benefit and redeems it. And that redemption might happen days, weeks, sometimes even months later.
Yeah, there's a time lag.
Exactly. This inherent delay creates this significant, constantly replenishing pool of cash, the float that Edenred holds temporarily.
Okay, so they're holding on to the client's money for a period. What do they do with it? Just let it sit there.
Oh, no, definitely not. They actively invest this float, mostly in very safe short-term financial instruments. Think money markets, short-term bonds.
Okay.
Now, here's the kicker. In a rising interest rate environment, like we saw very clearly in 2023 and 2024,
Yeah, rates went up sharply.
this float suddenly becomes a major source of high-margin income. The interest earned on that cash pool contributes significantly to a revenue line they call other revenue.
High margin because the cost of those funds is basically zero, right?
Essentially, yes, and the impact was huge. Other revenue more than doubled to $203 million in 2023, driven almost entirely by higher rates, and it kept climbing, hitting $247 million in 2024.
Wow, nearly €250 million just from the float.
It's a significant financial tailwind. It's not just a small bonus. Now, obviously, this introduces a sensitivity to monetary policy.
Meaning if rates go down.
Exactly. If, or rather when, interest rates normalize or fall, which management expects to start happening in 2025, that contribution from the float will moderate. It won't disappear, but it won't be the same boost.
That float mechanism sounds incredibly powerful, but how exactly do they manage that risk? Investing other people's money, even short term? There must be strict controls, right? What kind of instruments are we talking about specifically? Does it expose them to anything beyond just interest rate shifts? It feels like a bit of a financial high wire act, though obviously a profitable one.
That's a great point, and yes, it's managed very carefully. It's really about leveraging that natural latency in the payment cycle. They turn what's just a timing difference into a profit center. In terms of instruments, they stick to highly liquid, very low-risk stuff. Think money market funds, high-grade commercial paper, short-term government bonds. They're not taking punts on risky assets.
Yeah.
The primary goal is capital preservation first, then yield optimization.
So safety first.
Absolutely. The main risk, as you identified, is really a sustained period of extremely low, zero, or even negative interest rates, which would significantly shrink that other revenue.
Mm-hmm.
But their diversified investment strategy across different safe assets and geographies, coupled with a very robust risk management framework, helps mitigate volatility. They aren't taking big bets. It's income generated from the natural flow of their core business.
Okay, that makes the high wire act sound a lot more grounded. It's fascinating how they built that engine. Now, shifting gears slightly, Edenred's operating across 45 countries, processing, you said, nearly 45 billion in annual business volume, mostly digitally. That scale is just enormous. How do they actually manage that kind of global scale effectively? And what does it tell us about just how deep their digital transformation has gone.
Yeah, that global reach is definitely one of their core strengths.
Mm.
It gives them resilience if one region's economy slows down, another might be booming,
Hmm.
and it exposes them to markets at different stages of development, different growth rates. Let's break down that geographic diversification. Europe is still their biggest and most mature area. It accounts for 61% of their operating revenue.
Over half.
Yeah, 1.58 billion in 2024, and it still grew at a healthy 7.9% like for like. France obviously is a huge market for them, a real cornerstone. Growth in Europe is mostly driven by getting deeper into existing markets, winning more clients, getting existing clients to use more services, and successfully cross-selling those beyond food solutions we talked about.
Okay. Mature but still growing.
Then you have Latin America. This region is really Edenred's primary growth engine right now. It contributed 29% of operating revenue, 769 million in 2024.
And the growth there.
Impressive. 15.4% like-for-like growth. Key markets like Brazil and Mexico have been real pioneers in adopting digital payments, often leapfrogging the older systems. This digital-first approach has historically led to higher operating margins for Edenred and LATAM. The demand there is just incredibly strong.
So LATAM is the powerhouse for growth.
Currently, yes. And finally, there's the rest of the world segment. It's the smallest, only 10% of operating revenue, about 258 million. But paradoxically, it's the fastest growing.
Fastest. How fast?
A remarkable 19.7% like-for-like increase in 2024. This includes high-potential markets in Asia and, significantly, North America. These areas represent considerable long-term expansion opportunities, especially the U.S. market, which is massive for employee benefits, but where Edenred is still relatively small.
So potential future growth engines there.
Exactly. And this whole geographic story is tied directly to their profound digital transformation. I mean, Edenred has changed dramatically. They've gone from primarily being a company distributing bits of paper
The vouchers.
to being a sophisticated, tech-centric platform company. Today, the vast majority, pretty much all of that, nearly 45 billion annual business volume, is processed digitally. Cards, mobile apps, online platforms. It's a huge shift.
It's wild to think how far they've come. I actually remember using those paper meal vouchers myself years ago. They felt almost quaint, analog. This must have been a truly massive, complex undertaking. What do you think was the biggest hurdle in getting everyone, clients, merchants, users, to fully embrace that digital leap? Was it the tech itself or something else?
You're spot on. It was monumental. And honestly, the biggest hurdle probably wasn't just building the tech, although that was complex enough. It was really the behavioral and logistical shift required from millions of users and merchants.
Changing habits is hard.
Incredibly hard. For merchants, it meant needing new payment terminals, maybe updating their accounting systems. For employees, it meant getting comfortable using an app or a card instead of paper they could physically hold. There was definitely inertia.
So how did Edenred overcome that?
By making the digital offering demonstrably better. They focused on the superior convenience, no more losing vouchers, instant balance checks on an app. They offered real-time tracking for businesses. They built in digital loyalty programs that paper simply couldn't support. Essentially, they showed everyone involved that the digital experience was far superior in almost every way. That made the transition not just possible, but desirable and ultimately incredibly successful.
So the value proposition had to be undeniable.
Exactly. And underpinning all this is a highly sophisticated 4-layer technology architecture. It's designed specifically for scalability and flexibility.
4 layers. Okay, break that down.
So at the bottom, you have the infrastructure layer. This is the foundation, cloud computing, data analytics, AI capabilities, their own proprietary payment tech.
A little lemming, basically.
Kind of, yeah. Then above that is the digital services layer. This connects the platform to the wider world partners, other systems. It uses a big library of APIs, application programming interfaces.
APIs, so other software can talk to their platform easily.
Precisely. Makes integration much faster, allows for new features to be rolled out quickly. The third layer is the business applications layer. This is what actually runs and manages the 250 plus specific payment programs Eden offers.
Orchestrating everything.
Exactly. And finally, the top layer is the experiences layer. This is what you and I or the corporate client or the merchant actually sees and interacts with the apps, the websites, the portals, tailored for each user group.
Okay, so this isn't just about making things run smoothly. It sounds like they've built a really modular system, almost like Lego bricks. What does that modularity actually mean for their ability to do things like acquire a company like Reward Gateway and plug it in, or pivot quickly to add new services like EV charging? Is this architecture their core advantage against older, maybe less nimble players?
You've nailed it. That modularity is a critical strategic asset. It's precisely why they can make a massive acquisition like Reward Gateway again, $1.3 billion, and integrate its capabilities relatively seamlessly without completely disrupting their existing operations.
So they can add new bricks easily.
Exactly. New capabilities, whether bought or built, can be plugged into this flexible architecture. It dramatically cuts down the time it takes to bring new solutions to market, whether that's rolling out Reward Gateway's engagement tools across Edenred's network or adding EV charging options to their mobility platform.
So agility is key.
It makes them incredibly agile, especially compared to legacy players who might be stuck with older monolithic systems that take years to change. This tech stack is absolutely a core competitive advantage, especially against more traditional, less digitally native competitors.
And this platform model, I assume, is scalable.
Inherently scalable. That's the beauty of it. They can handle massive increases in transaction volume or user numbers without a proportional jump in their costs. That creates significant operating leverage. Profits grow faster than revenues.
Which requires investment, though.
Oh yes, substantial investment. They pour money into tech every year, around 480 million euro gooding in 2023 alone. It's crucial for keeping the platform cutting edge, innovating, and strengthening those competitive barriers.
And it pays off on the bottom line.
Absolutely. Moving away from paper/production and distribution costs, that leads to structural margin expansion. Plus, the digital platform generates this wealth of transactional data.
Data. The new oil, as they say.
Well, it certainly opens up new avenues. They can offer value-added analytics to clients, targeted promotions via merchants, identify trends, potentially new ways to monetize down the line, turning what started as cost saving into a future revenue driver.
Okay, so they've built this impressive, scalable, global digital empire. But like you said, no company operates in a vacuum. What does the actual market look like? Who are their main rivals? And how do they defend this position, especially with nimble fintech startups seemingly popping up everywhere?
Right. The competitive environment is crucial. Edenred operates kind of at the intersection of two really big expanding markets.
Yeah.
First, employee benefits. This market is just booming globally. Why? Because companies everywhere are realizing that good benefits packages are absolutely vital in that war for talent we mentioned.
It's not just salary anymore.
Not at all. Benefits are key for attracting, keeping, and engaging good people, especially as expectations change. Second market is prepaid payment solutions. This is also growing rapidly, driven by the big shift to cashless, the explosion of e-commerce, and just the general demand for digital payment tools that offer better control and security.
Okay, two growing markets. What are the key trends shaping them?
Several big ones. Digitalization obviously is huge. Everything's moving from physical to digital platforms. This allows for more personalization of benefits, automation for HR departments, and powerful data analytics.
Right.
Second, the rise of remote and hybrid work. This has totally changed what employees need. Less focus on office perks, more demand for things like home office stipends, wellness apps, flexible spending accounts you can use anywhere.
Adapting to the new ways of working.
Exactly. And third, there's a growing focus on holistic well-being. Employers are looking beyond just basic health insurance. They're thinking about mental health, financial wellness, work-life balance. This creates demand for integrated platforms like Edenred's that can deliver all these diverse benefits seamlessly.
Okay, so the competitive landscape. Who's the main competition?
In the global employee benefits and rewards space, it's
Okay.
largely a duopoly. You've got Edenred, and then you have Pluxee.
Pluxee. That's the one spun off from Sodexo, right?
That's the one. Spun off in early 2024. Now, Edenred is the clear global market leader. They're roughly double the size of Pluxee in terms of revenue and business volume. In France, they're home turf. They have about 40% market share.
So number one globally. And Pluxee?
Pluxee is the solid number two globally, maybe around 25% share of business volume. But they are number one in many of the individual countries where they operate over half of their 31 countries.
Yeah.
There are smaller single country players too, but they just don't have the scale or the global reach of these two giants.
So Edenred and Pluxee are the big fish. How does Edenred protect its leading position? What's their moat?
Edenred's market leadership is protected by a really wide, durable, competitive moat. It's built on several things working together. The biggest is probably network effects.
We talked about that virtuous cycle.
Exactly. That powerful two-sided or even three-sided network. More users attract more merchants, which makes it better for clients, attracting more users. It creates massive barriers to entry. It's incredibly hard for a new player to replicate that interconnected network of millions instantly.
Okay, network effects. What else?
High switching costs. This is huge. For a company using Edenred, their solutions are deeply woven into the corporate fabric payroll system's HR platforms.
Right. Ripping it out would be a nightmare.
A complete nightmare. Switching providers is complex, expensive, disruptive, needs IT resources. It leads to incredibly high client retention rates for Edenred. Very sticky business.
Makes sense.
Then there's brand recognition and trust. Eden basically invented the meal voucher concept back in the 60s. They've built this globally recognized brand over decades that fosters deep trust with clients, with merchants, and critically with government regulators. Trust is vital in this regulated space.
That history matters.
It does. And finally, just sheer scale and distribution channels. Their global size gives them operating efficiencies, purchasing power for tech, etc., and their established B2B sales force with relationships built over many, many years. That's incredibly hard and costly for any new entrant to replicate quickly. You can't just magic up those corporate relationships overnight.
That's a pretty formidable set of defenses. But here's the key question, I think. How durable is that moat in today's world? With digital disruption happening everywhere, it sounds like the nature of their advantage might be shifting away from just the historical factors.
Absolutely. You've hit the nail on the head. That's the crucial evolution happening right now. Historically, yes, Edenred's moat was heavily tied to those favorable tax rules and the logistics of distributing paper vouchers.
Right, the old world.
Now, it's decisively shifting towards a technology-driven moat. By becoming this integrated digital platform and aggressively expanding into beyond food and beyond fuel services, they're doing a couple of things. They're increasing how often users interact with them daily, and they're embedding themselves even deeper into their clients' workflows.
Making themselves stickier, indefensible.
Exactly. The goal is to make their ecosystem indispensable for both the employer and the employee. And they're using the vast amounts of data they gather to constantly improve the value proposition, personalize offers, find new opportunities. This strategy makes them less reliant on any single regulatory advantage and strengthens their position against both old rivals and new fintech challengers.
Okay, speaking of fintech, let's talk about the fintech threat. How real is it, and what's Eden reading about it?
It's definitely real, arguably the most significant long-term competitive threat. You have these nimble tech-native fintech companies and neobanks who are brilliant at creating slick user experiences.
Often very focused on one thing.
Exactly. They offer unbundled, often cheaper digital solutions for specific things, maybe just payments or expense tracking or a financial wellness app.
So they could chip away at Edenred's business.
That's the risk disintermediation. Now, what these fintechs usually lack is Edenred's huge B2B sales machine, those deep corporate relationships, and the complex regulatory know-how needed for things like tax-advantaged benefits.
Okay, so fintechs are good at the consumer-facing part, less so the corporate regulatory part.
Generally, yes. So the risk is they might offer slick single-point solutions directly to employees or partner with companies to offer a more modern, unbundled alternative to Edenred's broader package.
So how's Edenred fighting back?
They have a multi-pronged response. The core of it is their own platform strategy. They're aiming to turn their own apps and services into a comprehensive super app.
A super app, like WeChat or Grab.
Kind of aiming in that direction for the world of work. By bundling more and more services, food, mobility, wellness, rewards, engagement onto one integrated platform, they make it the central hub for an employee's work life. This bundling increases stickiness and makes those single-service fintech alternatives seem less appealing. It's like offering a versatile Swiss Army knife versus making someone carry separate tools.
Got it. Bundle to increase value and lock in. What else?
Second, they're using their strong balance sheet for acquisition of capabilities. They buy innovative fintechs to bring their technology, talent, and sometimes customers in-house. That $1.3 billion reward gateway deal is the prime example. Instantly gave them a top-tier employee engagement platform and presence in the UK, Australia, and the US, leapfrogged years of development.
By Arthur's build.
Exactly. And third, they're doing strategic partnerships. Sometimes, instead of competing, they team up, like their collaboration with Nubank in Brazil.
Nubank, the huge digital bank.
By partnering, Edenred can tap into Nubank's massive user base as a distribution channel for its services. It turns a potential competitor into an ally and expands their reach efficiently.
Smart. Okay, platform strategy, acquisitions, partnerships. What about that regulatory piece? You mentioned it's a risk.
It is, and it's critical. The regulatory environment is intrinsically linked to Edenred's business. So much of their value proposition relies on those favorable tax incentives for their products in different countries. These incentives make their benefits tax efficient for both employers and employees.
Which makes them attractive.
Highly attractive. But that reliance creates a significant risk. Any adverse change in regulations can really hit the business. That proposed 5% cap on merchant commissions in Italy is the perfect example right now.
The potential 60 million EBITDA hit.
Exactly. It shows how vulnerable a chunk of their earnings can be to political or regulatory shifts. Plus, being such a dominant player means they face ongoing scrutiny from competition authorities. They've been fined in the past, like in France. So that antitrust risk is always there in the background. They have to constantly manage compliance and relationships with regulators.
Okay, so a complex interplay of market forces, technology shifts, and regulatory hurdles. It really paints a picture. So what does this all actually mean for the bottom line? Let's get into the numbers. How does all this strategy and market dynamic translate into Edenred's actual financial performance over time?
Right, looking at the financials over the past 7 years or so, it reveals a really consistent and frankly compelling story. You see strong, profitable growth pretty much across the board, very robust cash flow generation, and disciplined management of their balance sheet. It really highlights the resilience of the model and how well they've executed their strategy.
Okay, let's start with the top line. Revenue growth.
Impressive revenue trajectory. Total revenue grew from $1.63 billion back in 2018 to $2.90 billion in 2024.
Almost doubled in 6 years.
Pretty much. That works out to a compound annual growth rate, a CAGR, of about 10.1% over that period. And that growth comes from a mix of strong organic performance, signing up new clients, higher benefit values per user, plus those strategic acquisitions adding new services and markets.
Solid top-line growth. What about profitability?
Even better, actually. Profitability has grown even faster than revenue, which really shows that operating leverage from their scalable digital platform kicking in. EBITDA earnings before interest, taxes, depreciation, and amortization, a key measure of operational profit, has surged, went from $836 million in 2022 to $1.265 billion in 2024.
Wow, that's a huge jump in just 2 years. Over 50%.
Yeah, a 51% increase in just 2 years. It's significant. And this drove notable margin expansion. Their EBITDA margin climbed from 41.2% in 2022 up to a record 44.3% in 2024.
And that margin improvement comes from?
Several factors. The ongoing shift to those higher margin digital solutions, getting rid of paper costs, disciplined cost management generally, and as we discussed in detail, that substantial boost from the high margin other revenue generated by investing the float, especially with rising interest rates.
Okay, now what about net profit? I recall seeing a figure for 2023 that seemed a bit low given that EBITDA growth.
Yeah. Good catch. Yeah, the reported net profit for 2023 was $267 million. That figure was indeed distorted. It included a big one-off hit, a $158 million fine related to that French antitrust case we mentioned earlier.
Ah, the antitrust fine, so strip that out.
Exactly. If you adjust for that non-recurring item, the underlying net profit for 2023 was a much healthier $425 million. That clearly shows the core earnings power was still growing strongly, and that was followed by a record net profit of $507 million in 2024, confirming that underlying strength.
Okay, so the underlying trend is strong profit growth. What about cash flow? Is the profit converting into actual cash?
Exceptionally well. This is one of Edenred's real strengths, cash flow generation. They consistently convert a very high percentage of their earnings into cash. That's a key sign of earnings quality.
Wow, high.
Management targets a free cash flow, or FCF, to EBITDA conversion rate of over 70%, and they can consistently hit or exceed that. In 2024, it was bang on 70%, generating $881 million in free cash flow. In 2023, it was even stronger, 82.7% conversion, yielding $905 million in FCF.
That's impressive conversion. Where does all that cash efficiency come from?
A lot of it comes back to those favorable working capital dynamics we discussed. That prepaid nature of the business getting cash from clients before paying merchants creates a negative working capital cycle.
Right, the float again.
Exactly. That float isn't just generating interest income. It acts like a stable, very low-cost source of funding for the business. It massively boosts their cash flow generation without needing lots of external debt.
Got it. And finally, the balance sheet. How leveraged are they, especially after big deals like Reward Gateway?
They maintain a strong and flexible balance sheet. Management is really committed to keeping a strong investment-grade credit rating that gives them good access to funding at decent rates.
Than the debt levels.
Despite funding big acquisitions like the $1.3 billion for Reward Gateway, they've managed leverage very prudently. Their key ratio, net debt to EBITDA, was at a conservative 1.0x at the end of 2023 and 1.4x at the end of 2024.
That seems quite low for a company this size making acquisitions.
It is well within comfortable limits for an investment-grade company. It shows good financial discipline. And this financial strength gives them plenty of firepower for future growth, more investment, maybe more M&A, and importantly, returning capital to shareholders.
Okay, that paints a very solid financial picture. Clearly, this performance isn't just happening by accident. It sounds like it's underpinned by a very deliberate strategy. Let's talk more about that Beyond 22-25 plan. How are they planning to keep this momentum going, especially now they've made that huge digital shift?
Indeed. That impressive growth is very much guided by this clear, ambitious strategic plan Beyond 22-25. And it's coupled with a disciplined capital allocation framework that tries to balance investing for growth with giving returns back to shareholders.
Okay, tell me about Beyond 22-25. When did it start? What's the main goal?
It launched in late 2022. You can think of it as Edenred's roadmap to really leverage that fully digital platform they've built and cement their position as, their phrase is, the everyday platform for people at work. Yeah. The big overarching goal is driving sustainable, profitable growth. They have a long-term ambition aiming for $5 billion in total revenue by 2030.
$5 billion by 2030. That's ambitious. How do they plan to get there?
It's structured around three core strategic growth pillars, each designed to capture a different type of market expansion.
Okay, pillar number one.
Pillar one is scale the core. This is expected to drive about 60% of their projected growth. It's all about deepening the penetration of their existing core products. Think meal and food, fuel within the markets they're already in.
Squeezing more out of existing markets.
Exactly. A key target here is the SME segment, small and medium-sized businesses. Globally, that segment is still significantly underpenetrated for these kinds of benefits. So they're using segmented go-to-market strategies, making their digital offerings even more attractive and using data analytics to cross-sell and upsell more effectively within their huge existing client base, basically optimizing what they already do best.
Okay, scale the core. Pillar two.
Pillar two is extend beyond. This is slated for about 30% of the growth. This is where that diversification comes in, accelerating beyond the traditional stuff.
Beyond food, beyond fuel.
Precisely. In benefits and engagement, that means pushing harder into wellness, rewards, those employee engagement platforms. In mobility, it's growing the value-added services, toll management, maintenance, and especially EV charging solutions as fleets electrify. M&A plays a crucial role here, acquiring new capabilities to speed things up.
Right, buying expertise. And the third pillar.
Third pillar is expand in new businesses. This accounts for the remaining 10% of growth. This is about seizing opportunities in completely new, high-potential business lines or, importantly, geographies.
New territories. Where are they looking?
The primary target for geographic expansion here is the United States. It's the world's largest employee benefits market, incredibly dynamic, but Edenred currently has a relatively small footprint there compared to its strength elsewhere. Establishing a meaningful presence in the U.S. is key to unlocking that next big wave of long-term growth.
So U.S. expansion is a major strategic goal.
Definitely. And talking about expansion naturally leads to M&A mergers and acquisitions. It's a really integral part of how Edenred grows and innovates.
They use it strategically, not just randomly.
Very strategically. To enter new markets faster, acquire specific technologies they need, or broaden their portfolio of solutions quickly, they've got a good track record here.
Like Reward Gateway.
Exactly. That $1.3 billion Reward Gateway deal in 2023 was transformative for their benefits and engagement segment. Gave them that best-in-class tech platform and a strong foothold in the UK, Australia, and crucially, a beachhead in the U.S. employee engagement market.
So M&A helps execute the strategy.
Absolutely. They've also done smaller bolt-on deals like acquiring GoIntegro and PagBim in Latin America to strengthen specific market positions there, and they have the capacity for it. Back in late 2022, they estimated they had about $2 billion in M&A firepower.
So they can afford to keep buying?
They can, although the current focus seems to be more on integrating the recent big buys like Reward Gateway and maybe smaller, highly complementary bolt-ons, rather than another massive deal right away.
Okay, that makes sense. How does all this organic growth investment, M&A, fit into how they allocate their capital overall?
That brings us to their capital allocation framework. Management follows a policy they describe as balanced and disciplined. The goal is long-term shareholder value, but always while maintaining that strong investment-grade credit rating.
So balancing growth with financial stability, what are the priorities?
Three main priorities. First, and most important, is reinvestment in the business. Organic growth comes first. They allocate significant capital to tech and innovation to keep that digital platform ahead of the curve. Their target for annual investment spend, or CapEx, is consistently between 7% and 8% of total revenue. That's a serious commitment.
7 to 8% of revenue back into the business.
Okay. Second priority is strategic M&A, like we just discussed. Selectively deploying capital to buy companies that fit squarely into those extend beyond and expand in new businesses pillars.
Accelerating the strategy.
Exactly. And the third priority is shareholder returns. They're committed to providing attractive returns through both dividends and share repurchases. Their strong, predictable cash flow makes this balanced approach possible.
And you mentioned they've recently increased share buybacks.
Yes, and that's quite noteworthy. It might signal a bit of an evolution. With the major platform-building acquisitions perhaps done for now, and the business throwing off lots of cash, management seems comfortable returning a greater slice of the pie to shareholders. It signals confidence in their organic growth and a commitment to capital discipline. Investors usually like to see that.
Right. Let's talk about their shareholder returns specifically. What's their dividend policy?
They pursue a progressive dividend policy. The stated goal is to increase the absolute dividend per share every single year. That shows confidence in future earnings growth. For 2024, they proposed 1.21 per share, a solid 10% increase from the previous year.
And they have a track record.
A very consistent one. They've paid a dividend for 15 consecutive years now. That's impressive consistency, especially through various economic cycles and their own transformation.
15 years straight. Okay. And the buybacks.
They actively use share repurchases too. In March 2024, they started a $300 million dividends program. Then, reflecting their strong cash flow, they extended it to $600 million total to be done over 3 years.
Are they actually buying back shares?
Yes. By January 2025, they'd already executed the first $300 million, buying back 8.1 million shares. And here's the crucial part. Eden cancels all the shares they repurchase.
Cancels them. Why is that important?
Because it means the buyback is directly accretive to earnings per share, EPS, for the remaining shareholders. Their slice of the company and its profits gets slightly bigger automatically. It's a clear sign of aligning with long-term shareholder interests rather than just, say, using shares for stock options.
Okay, progressive dividend plus accretive buybacks sound shareholder friendly. All right, we've covered the business model, the ecosystem, the financials, the strategy, the capital allocation. Now, the million-dollar question, or maybe the billion-euro question. How does the market actually see all of this? What does Edenred's current valuation tell us? Is it priced correctly, especially when you compare it to its peers? Or is there maybe a disconnect?
Yeah, valuation is always the tricky part, isn't it? Assessing Edenred requires looking at it from a few angles. How its current trading multiples stack up against its own history, against its closest competitors, and maybe against the broader market for these kinds of high-quality platform-type businesses.
Okay, let's start with peers. Who do you compare Edenred to?
For a relative valuation, the key peers are pretty clear. Obviously, its main global rival, Pluxee.
Right, the Sodexo spinoff.
Exactly. Then you'd look at a couple of major players in the related mobility and corporate payment space companies like WEX Inc. and Corpay, which used to be FleetCor.
Okay, Pluxee, WEX, Corpay, what do the multiples show?
It's quite insightful. If you look at enterprise value to EBITDA, Edenred currently trades around 6.0x. Now, that's significantly higher than Pluxee, which is down at about 3.6x.
Big difference. Why the premium for Edenred?
It's generally seen as justified by Edenred's larger scale, its stronger historical growth track record, and its consistently higher profitability margins. The market sees it as the higher quality asset of the two.
Okay, how about versus WEX and Corpay?
Compared to WEX at 5.7x EVAPTA, Edenred's at a slight premium, but it trades at a substantial discount to Corpay. Corpay's EVAPTA is way up at 13.8x, and its forward price to earnings, or PE, is around 16.0x.
Huge gap with Corpay. Why is that?
Corpay is larger, more diversified, and maybe perceived as having different growth drivers. Now, if you look purely at PE ratios, Edenred's multiple of around 11.8x looks relatively modest.
Lower than Corpay, obviously, but how about Pluxee?
Interestingly, Edenred's PE is actually lower than Pluxee's, which is around 14.0x.
Wait, Edenred has a higher EBITDA than Pluxee, but a lower PE. How does that work?
It comes down to capital structure differences. Pluxee got spun off with a big net cash position, which mathematically pushes its PE ratio up relative to its EBITDA. Edenred, on the other hand, has net debt, which does the opposite. It makes its PE look lower relative to its EBITDA. So you have to be careful just comparing one multiple.
Okay, so capital structure affects the PE view. What about Edenred's valuation versus its own history?
That's where it gets interesting. Historically, Edenred has consistently commanded a valuation premium compared to other European companies, reflecting that strong financial profile and market leadership we've discussed.
Right, seen as a quality name.
Exactly. But over 2024 and into 2025, the stock really underperformed the market. Its share price hit multi-year lows, and that caused its valuation multiples to compress significantly, bringing them much closer to, or even hitting, historical lows for the company.
A derating, basically. Why did that happen? What spooked the market?
It seems to be a confluence of factors hitting at the same time. First, general macroeconomic concerns, especially the worsening outlook in Europe, its key market. Investors got worried about potential impacts on employment, corporate spending, things that directly affect Edenred's volumes.
Okay, macro fears. What else?
Second, those regulatory headwinds we talked about. Specifically, that risk of the commission cap in Italy became very tangible. It created a real overhang on the stock, with the market trying to price in that potential 60 million earnings hit. Uncertainty weighs on valuation.
Right, the Italy issue.
And third, shifting interest rate expectations. As central banks started signaling that interest rates might have peaked and could even start coming down.
The boost from the float would fade.
Exactly. The market began anticipating that the high-margin other revenue from investing the float, which had been such a nice tailwind recently, would normalize or decrease. That impacts future profit forecasts.
So macro, regulatory, and interest rate normalization fears all converging.
Pretty much. So the current valuation reflects this tension. On one hand, you have a high-quality business model, strong growth prospects, good management. On the other, you have these very tangible near-term risks. An investment view really comes down to whether you think the current multiples adequately compensate for those risks, or if maybe the market has overreacted and penalized the stock too much for potentially temporary issues.
Hold on a sec. If Edenred has characteristics like a top-tier tech or platform company, you mentioned that Rule of 40 score being really healthy. Why isn't the market valuing it more like one? Are investors just missing something fundamental here, maybe focusing too much on the voucher history? Or are these short-term risks truly significant enough to justify that disconnect?
That is the million-dollar question, isn't it? And it's a crucial point about how you frame Edenred's valuation. You're right. If you look beyond just the traditional business services label and assess it as a modern digital platform, the picture changes. It absolutely exhibits many traits of a high-quality SaaS or platform business. That highly recurring revenue, the strong network effects creating barriers to entry, the scalable low capital intensity model generating operating leverage, plus the long-term potential from data monetization.
Right, all the platform buzzwords.
They apply here. And that Rule of 40 metric summing revenue growth and EBITDA margin is often used for these kinds of businesses. Getting a score above 40% is generally seen as really healthy. Edenred's score, using EBITDA margin for its last fiscal year, was a very strong 47%.
47%. That's well above the threshold.
It is. And typically, businesses hitting that kind of score in the tech and platform space command premium valuation multiples. But when you compare Edenred's current multiples to many public SaaS or payments companies, it doesn't seem to fully reflect those high-quality financial characteristics.
So the market isn't giving it full credit for being a platform.
It appears not entirely. It suggests that while the market is definitely reacting to those immediate macro and regulatory risks we discussed, it might be underappreciating the underlying strength and long-term value of the digital platform they've built. There could be a perception gap, maybe still influenced by its legacy, or perhaps just a heavy weighting of the near-term uncertainties.
So if we connect this back to the bigger picture, it really sounds like the market is weighing these short-term headwinds very heavily against what looks like a fundamentally strong, evolving platform-like business, which arguably could create an interesting potential opportunity for investors with a longer-term view.
Precisely. That's the crux of the current valuation debate. It's a classic case of short-term anxieties potentially obscuring what appears to be a high-quality underlying asset with strong long-term prospects.
Okay. Now, no investment analysis is truly complete without taking a really hard look at the risks. We've touched on some already, but let's consolidate. What are the main challenges and potential pitfalls Edenred faces? And alongside that, how strong is the management team steering the ship through these, well, potentially turbulent waters?
You're absolutely right. Understanding the risks is paramount. For Edenred, they fall into a few main buckets: operational strategic, macroeconomic and governance related.
Let's start with operational and strategic. What keeps management awake at night?
Probably top of the list is regulatory and legal risk. We've hammered this point, but it's crucial. Their business model is deeply intertwined with favorable tax and social security rules in many countries.
Lose that, lose the edge.
It significantly reduces the attractiveness of their products. That Italian commission cap proposal is the immediate, tangible example of potential 60 million EBITDA hit. It highlights their vulnerability. And then there's the ongoing antitrust scrutiny that comes with being a dominant player. Past finds show this is a persistent legal risk requiring constant management and engagement with policymakers.
Okay, regulatory is number one. What else?
Technology and cybersecurity risks. Hugely important. They're a digital platform processing nearly 45 billion a year, holding sensitive corporate and employee data. That makes them a prime target for cyber attacks.
A breach would be devastating.
Absolutely. Financially, reputationally, in terms of client trust. They need to protect personal data, ensure their systems are resilient, keep the payment infrastructure secure. They manage this through massive, continuous investment in security, regular risk assessments, and strict compliance with standards like SOC2 and PCI DSS. Those are key certifications for handling financial and customer data securely. It's fundamental to maintaining trust.
Makes sense. Competition.
Competition is a dual threat. In the core markets, it's intense rivalry with Pluxee. That can lead to pressure on pricing, especially for big contracts. Longer term, the more disruptive threat might be those agile fintechs we discussed.
The niche players.
Yeah, the ones that can innovate fast in specific areas like expense management or wellness.
Yeah.
If Edenred fails to adapt and innovate quickly enough, these fintechs could gradually erode parts of their business or value chain.
Okay. Anything else operational?
Foreign exchange exposure. Because so much of their revenue comes from outside the Eurozone, especially booming Latin America, they're exposed to currency swings. If the euro strengthens significantly against, say, the Brazilian real, it negatively impacts their reported results in euros, even if the underlying business in Brazil is doing great in local currency. Creates earnings volatility.
Got it. Now, macroeconomic risks. How sensitive are they to the broader economy?
They definitely have macroeconomic sensitivity. Their revenue is tied to employment levels, more employees using benefits, and corporate spending, companies willing to offer benefits. So a major economic downturn with rising unemployment and companies cutting back would certainly hurt their growth.
But you mentioned some resilience.
Yes, there are buffers. Many core services like meal and fuel benefits are seen as pretty essential. They're often baked into union agreements or standard compensation, making them less discretionary than, say, a fancy new office perk.
Burger to cut.
Exactly. Plus, their geographic and product diversification helps. A slowdown in Europe might be offset by growth in LATAM, or weakness in meal vouchers, offset by strength in mobility solutions. They've shown resilience in past downturns, managing to grow even when the economy was shaky. So sensitive, yes, but with shock absorbers built in.
Okay. What about risks around management and governance itself?
Good question. There's always execution risk. That Beyond 22-25 plan is ambitious. It requires really effective execution, integrating big acquisitions like Reward Gateway smoothly, developing and scaling new products quickly, penetrating tough new markets like the U.S. successfully. Any major stumbles in execution could mean missed targets and a negative market reaction.
And leadership.
There's arguably some key person risk. The company's huge transformation and current strategy are very closely linked to the chairman and CEO, Bertrand Dumazy. He's been the architect. While they have a deep bench, his unexpected departure could create uncertainty about strategic direction. Good succession planning is crucial long-term governance here.
Okay, so those are the key risks. On the flip side, how do you assess the quality of the management team and the corporate governance structures in place to navigate these challenges?
Overall, the management quality and corporate governance appear to be quite strong, which is definitely a positive factor.
Starting with leadership.
Bertrand Dumazy, CEO since late 2015, is widely credited as the driving force behind Edenred's transformation into the digital platform it is today. He's overseen impressive growth and strategic evolution. The Beyond plan shows clear vision, and the consistent financial results under his leadership speak to strong execution capabilities. He's supported by a 10-member executive committee with deep expertise across different business lines and functions. Tech, finance, strategy. Seems like a solid, experienced team running the day-to-day.
And the board overseeing them.
The board of directors structure looks robust. It's a 13-member board with a very high degree of independence, over 90% independent members, excluding employee reps, which is best practice. Strong gender diversity, too, around 45.5% women, bringing diverse perspectives.
What about the combined chairman-CEO role? Sometimes that raises flags.
It can, but here it seems well balanced. While Dumazy holds both roles, there's a strong lead independent director, Dominique Dehinnen, who's also vice chairman. This structure provides independent leadership and a check on executive authority. Plus, they have specialized board committees, audit risks, commitments, compensation appointments, CSR, all chaired by independent directors, ensuring impartial oversight of key areas.
Okay, governance structure seems sound. What about alignment with shareholders? Are management's interests aligned with investors?
Several things point towards strong shareholder alignment. Management's long-term bonuses aren't just tied to hitting financial numbers. They're also linked to achieving specific non-financial and corporate social responsibility, CSR goals, under their ideal policy. That encourages a focus on sustainable long-term value, not just short-term profits.
That's good to see.
And as we discussed, that commitment to a progressive dividend and the substantial share buyback program, especially the fact they cancel the repurchased shares, clearly demonstrates a focus on returning capital and aligning directly with long-term shareholder interests. It sends a strong signal.
Okay, so strong leadership, good governance, shareholder alignment, important counterweights to the risks we discussed. Wow, what a truly deep dive into Edenred SA. We've journeyed through a company that's really pulled off a massive transformation from those traditional paper vouchers to this incredibly sophisticated digital platform that's woven into the daily lives of millions, seemingly creating value at every single turn.
Indeed. It's quite a story. You've got clear market dominance in many areas, that formidable competitive moat we dissected, really consistent profitable growth over years, and that incredibly strong cash flow generation.
Yeah.
It all forms a very solid foundation. And the Beyond 2225 strategy gives them a clear roadmap for pushing further into untapped markets and new services, especially with those Beyond Food and Beyond Fuel initiatives.
But as we definitely covered, it's certainly not a story without its challenges, is it? There are those very tangible risks, the potential for regulatory shifts like in Italy, that ongoing strategic dance with the agile fintech innovators, and just the broader macroeconomic climate that they constantly have to navigate.
Absolutely. And the current valuation really seems to reflect that tension, doesn't it? It's the
Right.
high-quality business with its recurring revenue and platform advantages on one side versus these very real near-term uncertainties on the other. The market is clearly wrestling with how to weigh those risks right now, creating a really interesting dynamic for anyone analyzing the company.
This whole discussion raises a really important question for you, our listener, to think about. If you were at the helm of a company like Edenred, facing both these incredible opportunities from digital transformation and significant regulatory headwinds, what would you prioritize? How would you strike that delicate balance between pursuing aggressive growth and managing risk very carefully? Especially in today's world where digital convenience is absolutely king, but trust, security, and regulatory compliance are arguably just as paramount. Something to ponder.
Well, thank you for joining us on this deep dive. We genuinely hope this has given you a valuable shortcut to being truly well-informed about the complex world of Edenred SA. It's always a pleasure to unpack these fascinating, complex companies and topics with you. Lots to think about there.
Until next time, keep digging deeper into the world around you.